Good morning, ladies and gentlemen. Thanks for joining us for this virtual version of Shanghai Pulp Week. It's a nice spring day here in London, and the blossom is out in Shanghai, although sadly we can't be there to see it. Now, as for London Pulp Week webinar, we put together a relatively brief but high quality agenda over the 2 days in order to reach the maximum number of people live. However, the recording will be made available for those that are unable to tune in now, or indeed those of you who want to watch it again. Hopefully we'll get this done by Monday, hopefully sooner. There is also a Chinese language option, which you should be able to find on the lower panel by the interpreter button. I'm sure our interpreter is very proficient in Chinese. I can't say whether she's fluent in pulp yet, but the option is there if you choose it. And lastly, don't forget the Q&A button. Pierre is going to try and filter out the questions as they come. So in order to increase your chances of selection, please type clearly, fully formed questions, and we'll hopefully we haven't covered anything already. We'll get to those as well. Now, obviously, missing a second Shanghai Pulp Week is not what we'd hoped for, or indeed expected. Here in the UK, it's a year and 1 day since we first went into the lockdown, to the first lockdown rather. But here we are again. And sadly, it seems some more months of disruptions are ahead. Now, the longer this goes on, of course, the more people are affected. And in recent conversations, it's become clear to me from talking with friends and clients that some have suffered bereavements, whether or not directly related to COVID. Meanwhile, others have become parents for the first or even second time. And in case you missed it, there's also been quite a lot happening in the pulp market. And throughout all of this, we've been unable to share in the good times and support each other through the not so good times. So it's really more important than ever that we stay connected, we look out for one another. And Roger will have a message for you on this topic a little bit later to close out the event today. But with this in mind, I'd really like to make a very special thank you to our very loyal sponsors who continue to ensure that we can make the best event possible. Now, given the lack of networking opportunities, it would have been an easy one to duck this time, but nobody hesitated to pledge their support, and we're extremely grateful for that. So on to business, and given the current market situation, we couldn't have timed this event any better if we tried. Now, we can't take the credit for that, of course, but I will take some credit for gathering another very strong crop of excellent speakers who are going to address the main issues affecting our business today. Although we can't be in Shanghai, China will obviously be a very strong focus throughout. And we're going to dive straight into this with our first speaker, Mr. James Lee, and he's joining us from the OG Trading Office in Shanghai. James is a personal friend of mine, and he's one of the most experienced people I know in the Chinese industry. Although he's still very useful, He's already had a very varied and successful career. He started out working for a number of trading companies, both state-owned and private, if I'm not mistaken. And he went on to work with several international pulp and paper producers. And over this 20-year period that I've known James, I suspect he's bought and sold almost every grade of pulp and paper and board known to man, all in the Chinese market. He's very well connected as well. And I should also mention that I'm very grateful to James over the years he's been really instrumental in helping us to communicate with the various Chinese conference organizers over the years. And he's played a really important part in helping us to establish that Shanghai Pulp Week. So our friendship extends beyond just the normal day-to-day of the up and downs of the market. Now, James and I, we're going to attempt an extended sort of Q&A session, which you're all invited to join in at the end, time permitting, and if we can figure out the Zoom format. But before we get into that discussion, very pleased to introduce a short video from our friends at Arauco. Thank you.
We face a critical situation for the planet and humanity. And the time to act is now. The challenge is huge. And we can all be part of the solution. On global warming, we are not neutral. But our carbon footprint is to mitigate climate change. We are leaving our footprint. And you, what footprint do you plan to leave? We are Arauco Carbon Neutral 2020.
Great. Thanks very much to our friends at Arauco. And James, welcome. Thank you for joining us. Please introduce yourself.
Good morning, good afternoon, and good evening from Shanghai. My great pleasure to be here together with Tom to discuss topics, issues about China pulp and paper market. Again, my name is James Lee. I'm the General Manager of Business Unit in OG Paper International Shanghai. That's a trading arm of Japanese OG Group. OG Group, I suppose, is not a stranger to many of you. We are one of the largest pulp and paper manufacturers in the world. Regarding market pulp, we also have something around 2.6 million tons annual market pulp capacity, and our pulp grades are quite diversified. We have both chemical pulp and mechanical high yield pulp. We have bleached, unbleached, and we also have paper grade and specialty dissolving pulp. Our pulp are produced in several places in the world, including New Zealand, Brazil, Japan, and of course China. In Nantong, we have the Chinese pulp and paper integrated mill. Thank you, Tom.
Thanks, James. Well, as you'll see, James and I have prepared some slides which we'd like to walk through. And I think, given the market situation, James, I think we've got to have to dive straight in and talk about prices. Now, if we can move to the first slide, I'm a little bit nervous to show this slide because it keeps changing so quickly. Can you just quickly give us a brief update? What's the price today? And and is this chart still current? Probably not.
Yes. Well, Tom, as you said, the pulp prices, have changed very fast and have increased dramatically and significantly since end of last year through now. So as far as March prices are concerned, I would say in China market for softwood grade, the prices this month are at the range of $950 to $1,000 per ton net basis, depending on which grade you are talking about or which orange of the supply. And for eucalyptus pulp, yes, the price is, it's somewhere between 720 to 730 net basis. And there are several companies already, suppliers already announced April order offers, already. And Russian Lim was the first one announced their April order prices for their grades, softwood, hardwood. For softwood, they announced the $1,000 as April price, and hardwood is $800. And also, Arauco announced their April offers too, but the company only told customers, they could supply unbleached kraft at $850 for April business. That is $70 up from March. And okay, but Arauco didn't offer anything for softwood and hardwood. They told their Chinese customers they are in a very tight supply due to some production loss, So, yeah, I know. The last one is Suzano newly released April order for their eucalyptus pulp. It's at $780 per ton.
Yeah, I saw that this morning on the press. So we're already higher than we were in 2017-18. But it seems to me that the drivers are a little bit different this time around to how it was 3 or 4 years ago. And in particular, we're looking at quite different trends in the downstream paper markets. Can you comment a little bit about these individual paper sectors and how are the Chinese paper makers able to afford such high prices?
Sure, Tom. Yes, today's pulp prices already hit the peak seen in 2017 and 2018, but the numbers may not tell the story in full. To me, I think in 2017 and 18, paper prices were increasing alongside or even ahead of pulp price increase. And we know the main driver in last cycle for paper prices up, that's the so-called supply side reform in China. There are huge backward paper capacities or environmental unfriendly capacities were kicked out from the market due to environmental concerns. So supply got tight, and under certain circumstances, paper prices could go up very quickly. But this time, what we see is more like pulp prices going up very fast and very significant, and paper manufacturers, were forced to lift up the prices for their finished goods in order to ease the pressure of cost surge. Of course, the situation may vary grade by grade, and the red side chart shows everboard prices movement. We can see clearly how quickly and how significantly everboard prices has gone up since second half through today. It's already set up the record high today at over 10,000 RMB per ton. Of course, we know the drivers behind the sense. Firstly, everboard is the packaging grade paper, and it's regarded as essential goods. Even during the COVID-19 pandemic. And secondly, that's the substitution of this of recycled grade by this virgin grade.
Right.
Many people we know the in China what's happening regarding the recovered paper, import ban, complete ban of solid waste from January 1st this year, and lastly, it's maybe not the least. That's the consolidation for the segment. It's much higher today versus 2 to 3 years ago. So after APP acquired Bohui in middle last year, the new company, the new group controls close to 50% of market share by capacity. So that be not a surprise to, suppliers in a more unique position to transfer the cost pressure downstream if needed.
Yeah.
So this is why Everboard is probably the strongest performing segment so far in China.
Right. How much pulp goes? How much chemical pulp goes into ivory, roughly?
Okay. The furniture could vary, Tom. Grade by grade. If you talk about commodity grade or the specialty grade, food grade or liquid packing,
right,
it could be different. But roughly, for this the grade, totally 3 layers. The top layer is at the back layer is all chemical pulp. It's softwood, hardwood, something around 40-60 or 60-40. But the middle layer is, of course, it's all the high yield pulp. Many of Chinese mills are integrated with their own APMP or BCTMP for that to be used in the middle layer. Of course, some of them also needed to buy BCTMP from outside, both softwood and hardwood. Yeah.
Okay. So that's probably the most positive sector, I think. If we move on to the next slide, we see, I think we're showing the tissue and the fine paper, and these are slightly more intensive users of chemical pulp, I think.
Right.
Go to the next slide, please. Thank you.
Yes. For tissue and printed writing, of course, we can see clearly prices are also going up. But compared with Everboard, it's they're still some way off from the peak in 2017 or 2018. Especially for tissue, Tom, as you said, it's globally, it's about 40% of market pulp goes to tissue manufacturing. So what is going on in tissue segment is means a lot to market pulp, both suppliers and customers. And I have to say, we can see clearly tissue suppliers would also want to lift up the prices for their finished goods. But unfortunately, very recently, their effort to lift up prices further met the strong resistance from downstream customers, particularly for those small and medium ones, because most of these players are just jumbo roll producers. They're compared with the top brandings, they are not so financially strong. They are holding less pulp stocks. So the current high pulp prices is really hurting these manufacturers. I can give you an example, just very recently, what happened this week, last week in Baoding area. That's the area not far from Beijing, where there are totally something 3 million tons annual capacity tissue manufacturers, located. And due to the worsening of their margin, and also due to their failure to lift up prices further of their product, it's about 50% downtime they're going to take from middle March through end of March. So this is really causing some concerns about how that could impact to the pulp demand for this segment. Yeah.
Got it.
And for fine paper, printed writing, they are somewhere in between. I see tissue and Everboard. Prices are going up, sure, and they are still enjoying quite nice profitability at this moment. But again, the questions remain to be answered about the downstream, how capable the downstream customers, converters, printers can absorb the high cost from the paper suppliers.
Yeah, I suppose the other thing, so it sounds like things are starting to the margins are really starting to bite around now. I guess the other point is that even if they are successful to keep increasing the paper prices in China, that does then have an impact on the trade balance, right? On the import and export of paper. We'll talk a bit. I think we have a slide on that a bit further along, so we won't mention that now. Do you have the other main, I guess, concern for people is inventories? Do you see? Is there any indicator or data we can use? I mean,
yes, inventories, transport are closely monitored by many people from our industry. I would say in January, if we look at it back to 2020, the destocking was taking place, and the Chinese port stocks went down all the way to the lowest level in December last year, at something around 1.7 or 1.8 million tons from the peak, over 2 million tons. Right. And but in the last 2 months, January, February, the port stocks went up a little bit more, mainly because the slow activities during Chinese New Year holiday. So some mills were taking downtime, and collecting from the port of the pulp was getting slower. So if nothing special, we're expecting the port stocks will gradually going down further in the next couple of months. If mills keep the good operation or at current level, yeah.
But there doesn't. It's nothing kind of extremely worrying in the short term on that front. Then it doesn't seem, if anything, they're quite low.
I think so, Tom. If we just look at the absolute number 1.7, 1.8, it's still much higher than the average in past 10 years, right? It's right. That was standing maybe only 800, 900,000 tons, But given today's unbalanced supply demand and also the shipment issues, are worrying customers. Probably they would like to keep a little bit more than normal. So this is something many people call the new normal numbers for the stocks. Yeah.
Great. Okay. Let's push on one slide, please. And of course, this is a subject which I know has been occupying many people over the last couple of months, and that's the Shanghai Futures Exchange. This is another big difference compared to 3 years ago, because as I recall, the futures contract for pulp only launched in late 18, because I remember very well it coincided with the cycle, the down cycle in pulp. So it actually had the opposite impact on the physical market than today. What's going on? This chart might well be out of date now, because but it certainly tells the story of what's happened, how the futures contract has led up the physical market over the last 6 months.
Yeah, Tom, as you said, this is relatively new stuff to our industry, and this was only launched in November 2018. But even it's relatively new stuff to many people, but it's really making headlines and topics, more and more. And I must say, it's also very close connected with the physical market as well, especially from late last year through today. What the crazy or explosive rally experienced in Shanghai futures market. Of course, maybe it's not so difficult to understand from the financial point of view if such a huge stimulus approach being taken by many countries, United States, such a huge stimulus package, closely to $5 billion, So liquidity is very high in financial markets. So inflation seems inevitable. This is also, I see, in the line with global commodities movement in the futures market. But maybe same time, we couldn't deny what's happening in Shanghai futures market is, to some degree, exacerbate the volatility of the physical market as well. Because we know in the past several months, there were the huge arbitrage opportunities created.
Yeah.
The futures market outperformed the physical market. So those investors could have the opportunity to take a long position in futures, but buy pulp from international market at lower prices, right?
Right.
So okay, I must say also, as you said, this chart looks a little bit out of date because in last 2 weeks, actually we have seen quite some correction taking place in Shanghai futures market.
Yeah,
and the prices already down.
Can we go to the next slide, please?
Yeah.
I think this slide is not showing the late. In fact, this is a bit misleading. So we will change this slide for when we distribute them, because as I understand it, James, the latest contracts are below 980 now. Is that right? That's right.
Right. What I want to say, Tom, because what happened in the last 2 weeks, the big correction taking place in Shanghai futures market. So, Chinese traders reacted very quickly to lower their resale prices, trying to minimize the risk for their stocks.
Right. So, but yeah, I think this is one. I've taken a lot of questions personally about the futures exchange, and this seems to be an area of confusion when we show such a high volume of pulp traded to make people understand that this doesn't impact the actual physical amount of pulp being transacted between the futures exchanges is relatively small, right? And most of this volume is actually traded by people with no interest in the real pulp market at all.
Right, Tom. Yeah, compared with the trading volume and also the open interest, the peak open interest, it's the open interest disappears quickly as each contract expires. So the final physical delivery volume is actually quite small.
Yeah.
It's almost can be ignored. For instance, for the March delivery contract, it's the physical delivery volume was only something around 50,000 tons. Mm-hmm. So it's almost nothing.
So I think what we can say, if I can summarize on the futures exchange, it's really the pulp market would still be in a very strong situation. We would still have a price rally, but perhaps the futures exchange is amplifying the price movements in the physical market.
Yes, I agree. What you said, Tom.
And it could, just as it could amplify it on the upside, it could also be a destabilizing factor if the macroeconomic winds change.
Right.
Okay.
Right.
Let's move on, please, because we have a few more to get through. Can we go to the next slide, please? Yeah, so we're stepping away from the price discussion specifically and just looking at the general economic situation. I'm just staggered how China has apparently controlled the virus and has managed to stabilize its economy so well. And I think, but even in China, these charts are the official numbers, and they're showing that GDP fell to around 2.5% growth last year. But more importantly, if the slide on the right-hand side shows that the private consumption, the spending from Chinese consumers, which is the most important driver of paper and board demand, that actually seemed to contract, but which is obviously quite a negative indicator. But I think, if I'm not wrong, it was very much a different story in the second half of the year. So it was a very steep contraction in the first half, and then a big growth in the second half. Is that correct?
Yes, Tom, you're right. The world economy was heavily hit by the COVID-19 last year. Of course, China was not an exception. But fortunately, China was could emerge from the crisis very quickly, and basically from Q2, everything was almost back to normalcy. So look at the GDP growth. China was probably the only main economy reporting the positive growth, even the lowest in the last 40 years, only 2.3%. And also, as you said, if you look at the structure of the growth, the domestic spending is still negative. So something means, the potential for this year to grow this year and also beyond, And also something I want to mention here, for last year's China economic performance, actually, the export was also it's quite surprisingly strong, We had the 4% export growth last year, when many other countries were struggling in lockdowns. China was probably the few countries, if not the only one, was able to provide goods to contain the various needed from the rest of the world. So China export was very good last year. Of course, this is also a supportive factor to paper and board consumption last year. Yeah.
And how do people, obviously in Europe and elsewhere, we have had second and now, sadly, even third waves of the virus, which means we are in a continual state of restrictions and then loosening and then restrictions. And in fact, last summer, we seemed to have very, very low infection rates here in the UK, and then they rose very dramatically over the winter time. How did China manage to, do you still have these spikes and these resurgences, or has it gone completely?
It's almost gone completely. Of course, we still report new cases every day, but it's 100%, from outside.
Wow.
So domestic cases, it's zero, has been zero for quite some time. And now the government is encouraging people to have the vaccination. So this is something, is taking place in China.
So are people in general feeling quite confident? The average man on the street, do they feel confident, or what concerns them generally now?
I would say, Tom, people are very confident about their daily life. It's our daily life is already 100% back to normalcy. Okay, right. Maybe the only thing still something we cannot do is the international travel. It's maybe not only about what's the policy China side. It's also some policies preventing international travels, to other countries.
Sure. Okay. Thank you. Let's move on to the next slide, please. This is going back to our world, the paper and board world. And again, these are the official estimates. And even though we see, Chinese economy is very resilient, very strong, relatively speaking, these numbers, which come from the official sources, are still showing quite a mature paper and board industry. It seems like, the overall output peaked in 2017 and may have grown a little bit last year, but nothing really, dramatic. Is that what you're feeling from actually being active in the market? And could you make any guesses for 2020? I think the numbers will come in. Will they come next month? The official numbers?
The official data is likely to be available from China Paper Association, usually in May or June. So we're going to have that data very soon. But before that, of course, based on the preliminary data from China National Bureau of Statistics, it's indicated in roughly nearly 0.8% growth 2020 for paper and board output versus 2019. It's their number is 127 million tons. Okay, personally, I would not be surprised, to expect, tissue will definitely have the positive growth for output, that's for sure. And maybe print and writing coated grade maybe some down, a little bit down. And for uncoated maybe flat or some increase. But every board again is definitely the big winner. Must have quite positive increase. Big increase, but to big degree at the cost of duplex board, recycled grade. So, for brown grades, cast liner, medium, I would not be surprised to see quite some decline. For the grades.
So clearly, there's been a very divergent kind of trend according to each sector, because even throughout this relatively stagnant few years, we've seen pulp imports increase by over 4 million tons, I think, since more than that since 2017 or 18. So there's obviously been a huge change in the kind of furnish and bias towards virgin fiber paper and board.
Right.
And also, I know there's quite a lot of excitement about the reduction of plastic consumption in China. And can you talk about any kind of, we talk a lot about it, but we often, when we're asked, how to quantify it and can we see real world examples? I mean, I'm definitely starting to see it very visible now over here in the UK, with packaging materials that are clearly changing into renewable packaging. But do you feel the same is happening in China? Does the government?
Yeah, that's definitely the same trend is happening in China, Tom. But again, as you said, probably it's hard, to quantify exactly how much of those replacement or substitution taking place. But anyway, in general, we're quite exciting to see, more paper and board products are being used to substitute plastic products or those stuff. I give you one example. That's plastic straw, to be served in restaurants, coffee shops, But nowadays in big cities, Beijing, Shanghai, or many places, we can easily find the available of the paper straws, in those places,
Well, I haven't done the maths, but I always think that we're going to need to do more than. I don't use a straw, so it's not going to make any difference to my, plastic or paper. Anyway, but no, clearly that's something else that's a good positive in China as well. We're going to have to skip on, I think, because we're already getting up against the time. So, but there is a couple of slides that I'd really like to focus on. If we could go forward one, maybe let's go forward another one, please.
Okay.
And this is and so I think what we're saying is that yes, there's still growth in China, and it's very variable depending on the end use application. But when, we at Hawkins Wright, we've just done our sort of deep dive into the Chinese market, and we, as always, adding up all of the new investment projects in all the different sectors. And we see a clear acceleration in investment activity over the last 12 months. And it's actually in all sectors, not only tissue, although that is still very strong. And so it seems a little bit, excessive relative to, number one, the existing overcapacity in the industry, and number two, the demand trends, which, they may be positive, but they don't seem to be that positive. So what's going on? Why are all these companies investing so much?
Tom, this is a really big question. Actually, this is a question, we asked ourselves when we got to know so many new investment or new projects are going to be put in place, Okay, but at the same time, look at the more detailed what going on for these projects, probably we could have better clue behind the scenes. First, if you look at these projects, basically there are two grades they are going to build. First, it's packaging grade. That's basically folding box board, everboard. And secondly, that's large tissue. It's only the few printed writing, but I would say it's more in a specialty grade printed writing rather than normal grade. Okay. So we know, both everboard and tissue are the two, very hard segments have the strong potential to grow. So it's not a surprise. And secondly, if you look at the locations of these projects, basically two places or two areas. Firstly, that's the Chinese southern coastal provinces like Guangxi or Fujian. And secondly, that's along the Yangtze River in the Hubei or Chongqing. For those in the south coastal provinces, of course, I would not be surprised if these new projects, the targeted market, definitely not limited to Chinese territories only. China, together with other 14 countries, just signed the world's largest free trade, multilateral free trade agreement. It's RCEP, including 10 Asian countries and Australia, New Zealand, Japan, and South Korea. So if after some necessary legislature procedure, this agreement will take effect, very likely from the beginning of next year. So to many Chinese companies, regard this a very big opportunity, for their products to not only market in China, but also in these countries with low tax or without tax, So this is something also very encouraging. And also, if you look at these projects, their location also makes them easy access to wood resources from outside, wood chips, especially for imported wood chips. So I would not be surprised, most of these projects will rely on chips from outside, maybe one or two pulp lines, especially those mechanical grades or semi-chemicals. Probably they can find some local resources of wood fibers, either wood or non-wood. But again, most of these pulp lines, I guess, they have to rely more from chips from outside.
Yeah.
So to me, Tom, it's more. It's not about the It's not about whether the wood resources is from outside or from China domestic. It's maybe more about how high the cost, to afford for these projects going ahead.
Yes, indeed, because it seems to me from the table that, one of the leading investors, Nine Dragons alone, has ambitions to produce as much pulp as Suzano, and yet they, as far as I know at the moment, they don't have a very established wood supply there, and clearly, in Brazil, the pulp industry took 40 or 50 years to establish itself, into its current form, and yet China is attempting to follow, in a very short period of time, without any local wood resource. So I guess that was my last question, really. Nothing's happened in China regarding the forest policies or land ownership policies that would, because I know China could, if it changed its policies, I'm sure it could develop more eucalyptus plantations, but I don't think that's happened. Is that right?
I got the question from Tom. Thanks. It's I have not seen any big change regarding the forest or plantation policy in China. No.
Okay, listen, I think we are already a little bit up against time, but I'm going to, One question which I can see here is current situation of the tissue producers. Going back to that discussion, we know that there's big overcapacity. Are you saying that you feel that there'll be pressure on prices? And then the second question is, can there be more consolidation in tissue, or is that will it remain very fragmented?
Yeah, I think this is really a very good question. Of course, probably I'd like to answer the second question first. It's regarding the possible consolidation in tissue segment. Yes, I'm expecting more consolidation in the segment because we know the top four of Chinese tissue manufacturers. Actually their market share is only maybe 30 or 40 or less than 40% so far today. So it's relatively still very fragmented. And okay, back to the first question. Yes, the small, medium tissue manufacturers, basically they are the jumbo roll suppliers. Okay, they are the one suffering the most from the high cost of pulp and other raw materials. And same time, they find it very difficult to transfer the cost surge to downstream. So in the end, they have to take down time to ease the pressure.
Right. Okay. I think that's all I'm going to take now because we could go on, and obviously we just scratched the surface, James. But thank you so much for your time. I know it's late in Shanghai now. I hope you can stay up for another hour before you go home and listen.
I will. Thank you, Tom. My pleasure.
Yeah, but thank you very much. I look forward to seeing you again in China, I hope. Although that, in fact, before you go, as I'm aware, the CPICC is planning to make its event in September, late September this year.
Yeah, that seems that's the plan. Yeah, CPICC is considering.
But I think it's going to be very unlikely that international travelers can visit China. So we are pinning our hopes on March 2022. But hopefully it will be before that, but we'll have to just wait and see.
Right.
But thank you. Thank you again, James. Much appreciated. Take care.
Thank you, Tom. My pleasure.
We're now going to move on to a subject very close to everybody's hearts, and I'm very, very happy to welcome Martin Dixon. He is Head of Research Products at Drury Shipping Consultants, and he joins us from here in sunny old London. Well, it was sunny when I came to work. It's not quite so sunny now, but it's dry at least. We've had a very fruitful information exchange with Martin over several years. And it's been a long-held ambition to have Martin participate in one of our London events. And it's a shame we don't hear from him in the flesh, of course, but the timing of his invitation could not have been more fortuitous given the extraordinary situation currently going on in shipping markets. So I'm really, really happy to welcome Martin. Before I hand over to him, I'm very pleased to welcome a short message from Metza.
We want to help our customers develop in a sustainable way. Our shared value chain begins in the Finnish forests, which are managed so that the trees' growth and regeneration are ensured. Private forest owners, ordinary families, own 2/3 of the forests in Finland. We make good use of every part of the tree. Heavy logs are used for sawn timber and smaller wood material for making pulp. More than 90% of the wood Metza Fiber uses is certified. We always know the origin of the wood we use. With our help, you can be assured that the raw materials for your products are always responsibly obtained.
Hello, and thank you for the opportunity to present to you today, and also thank you to Tom for that great introduction. So I'm going to provide you with Drury's outlook for cargo shipping and I'm looking particularly focusing on the container and break bulk markets. So if we move on to the agenda slide, the starting point for the presentation will be to provide a brief introduction to Drewry for those of you who don't know us. And then I'll look fairly closely at the container shipping market, starting off by looking at the development of trade, outlook for capacity deployment, container equipment availability, which has been a key thorny issue for many of you, before I then look on to what that means for the outlook for container freight rates. And I'll then look at the outlook for the break bulk shipping market before I take any questions you may have. So moving on to the next slide, and the information about Drewry. So we're a London-based shipping consultancy. We've been around now for over 50 years. And in fact, last year was our 50th anniversary celebration. We have other offices in Delhi, Singapore, and Shanghai. And we do two principal things. We publish research on the various shipping markets, and particularly forecasting those markets, as well as providing financial research on the financial performance of individual shipping companies. And the other thing we do is to provide advisory services to stakeholders across the shipping industry, and also particularly to cargo owners to help them procure capacity and secure the best freight rates in the market. So then moving on to the next slide, where we're going to look at the outlook for the container shipping trade, and which is now seeing a recovery, which is now well underway. And if we then move on to the next slide, we'll be showing you a chart. And this chart is showing you the percentage change in container port throughput by region. And so the top chart is showing you the situation for 2020, where we estimate the trade contracted by just a little over 1%. So by far the worst year for the industry over the last 10 years, but a much better year than anyone could possibly have anticipated earlier on in the pandemic earlier that year. You can see that the impact on the different regions of the world varied quite a bit, but all regions were negatively impacted. The second quarter of last year represented the trough of the market, where the market contracted by around 8%. And from the third quarter onwards, we saw a recovery in trade, which is still taking place as we speak now. If we look at the bottom chart, we then see the situation we're forecasting for this year, and we're forecasting a very strong rebound in trade of approaching 9%. As you can see, there's quite a variety then across the different regions there too. The rebound that we're forecasting for this year will be by far the largest increase we would have seen in the last decade. So the last time we saw this type of increase was when the industry rebounded in 2010, but this followed a severe contraction of around 8.5% in trade back in 2009. So this rebound this year is really quite unprecedented. The other thing, frankly, is that it's incredibly uncertain, because the trade outlook is so predicated on the outcome of the COVID-19 pandemic containment measures. So lots of assumptions lined up there. And in subsequent years, we're expecting the trade to continue to expand, but at a much more moderate pace of around 4.5% over those few years. Because the big question then is, why is it then that the trade actually didn't contract to the degree that it has done in previous economic recessions? So if we move on to the next slide, we'll try to explain some of this, which is showing you US personal consumption by type. And the main reason for the fact that the contraction was nothing like as bad as people thought was that Western consumer spending ended up being much higher than anticipated due to very high levels of involuntary savings. So these are savings that many of us made because we were all locked down and we couldn't therefore spend money on services, whether they be commuting to work, taking holidays, eating out, going to the cinema or traveling or whatever it was. So therefore there was a switch of spend, which is still taking place, into consumer durables. And that's illustrated very clearly here. This is data from the US Census Bureau, which shows, if you look at the durable goods spend by quarter for the first 3 quarters of last year, you can see that by the third quarter, very big increase in durable goods spend compared to the year earlier. The first quarter, actually, there was no change, and hence why there's no bar there at all. But you can also look to the right, you can see services spend there contracted quite a lot then in the second and third quarters. The other reason for the rebound has been a lot of restocking of inventory by retailers and manufacturers. And this is particularly because they ran down inventory holdings when the pandemic took hold, in expectations of a severe contraction in trade, but in fact that proved to be a false alarm, and therefore they've been restocking and therefore having to catch up. So for this year and the following years, we've had to make a number of assumptions then about what will happen to the COVID-19 pandemic and the containment measures associated with it. But we do expect over the course of the year that there will be a gradual switch of spending emphasis from consumer durables back to services as lockdown restrictions ease through the course of the year. And that will see overall demand levels slowing as we go later into the year. Okay, so let's move on to the next slide and let's look at capacity deployment. So what's been interesting about the vessel capacity deployment of the carriers is that despite this latent overcapacity, actually, as many of you know, there's a shortage of capacity at the moment. And even prior to that, carriers were very adept at managing the capacity when the trade fell off. So let's move on to the next slide and just look and see then how capacity development has been progressing relative to overall cargo demand. So the dark blue line there is tracking overall cargo demand. We're using container port throughput as a proxy there, and the brown line is then tracking the development of the container shipping fleet. And this here, we're looking at the year-on-year percentage change. So at the end of last year, the fleet amounted to around 23.5 million TEU, and it grew by around 3% over the course of that year, a bit slower than it has done in previous years. But clearly much faster than cargo demand, which contracted, and therefore adding to this latent overcapacity in the market. However, the carriers were very adept at managing capacity, as I mentioned earlier, and taking capacity out of the market, and I'll come more back to that in a minute. So this year, we're expecting capacity growth to accelerate to around 4%, which will come as some relief, but obviously at the moment capacity conditions are extremely tight, and I'll come on to lots of reasons for that in a minute. But a lot of the problem with that has been around very heavy port congestion, which is tying up vessel capacity as vessels wait at sea, waiting to get a berth. And of course, recent news then of a container ship which is now blocking the Suez Canal, which is preventing the transit of ships through that passageway. A very significant amount of world trade moves through there. That will require vessels then to divert around by the Cape of Good Hope of South Africa, and that will add typically, say, a week's additional sailing time to the transit time between Asia and Europe, for example, and indeed in reverse. The effect of that will be to soak up more capacity and therefore restrict capacity even further, although we would expect that blockage and that stranded ship to be relieved within the next few days. I think the Egyptian authorities have indicated that could happen within the next couple of days, so hopefully not too much disruption. Looking ahead then, you'll notice that for 2023, we're projecting that there will be a bit of a spike in the container shipping fleet growth to around 4.5–5%. And this is because in the first quarter of this year, there's been a spate of ordering of new vessels. In fact, over 1 million TEU of new shipping capacity has already been contracted so far this year, way above anything we've seen in recent times. And this is because the carriers have been making a lot of money with their high freight rates, and also the prices of new build ships from shipyards is pretty low at the moment because shipbuilding has been in the doldrums recently. So there is a concern then in the industry, at least, that this could lead to a spate of over ordering and the carriers get back to their bad old ways of injecting too much capacity into the market. You have the same issues, I know, in the paper and pulp business. But actually, if you're hoping then that might lead to a big slide in rates, we don't think that's likely to be the case. The actual order book today only represents about 15% of the global shipping fleet, which is pretty low by historical standards. If you think back to 2008, it was as high as 60%. But we think there is still potentially some limited risk, and if this risk does arise of over-ordering, it may be from state-backed carriers that are under pressure to support native shipbuilding sectors. So we still think there is a risk there. However, what is holding back ordering of new ships across all the shipping sectors right now is this uncertainty with regard to future propulsion systems in compliance with new carbon emission reduction targets that will come into play soon. And so the impact of, because there's so much new technology, new ideas coming into the market on how ships could reduce their reliance on fossil fuel, this is slowing down the ordering of new ships. The ship owners are concerned about ending up with assets that may become redundant in the near future. Okay, if we move on then to look to the next slide and look at how carriers have been managing capacity, particularly through the early part of last year when trade collapsed. This was through a very large number of cancelled sailings. So this chart then is tracking the number of cancelled sailings by week on the major trade lanes. And back in April of last year, as much as 10% of the global container shipping fleet was idled. That's a similar percentage actually to what was idled back in 2009 in the last big downturn in trade. But of course, because the fleet has grown so much over the last decade, the actual capacity of ships idled was much, much greater. And on certain trade lanes in April last year, as many as 30% of scheduled sailings were cancelled or blanked to cut capacity. Now, as you can see, looking at the chart, the number of cancelled sailings has fallen over the course of last year and right down to the current time, where very few sailings are cancelled at all. In fact, everybody is doing whatever they can to grab hold of any spare ship to move containers. Okay, so let's move on to look at the next slide, which is we're looking at container equipment availability. So container shipping capacity is not just about enough ship capacity, it's also about enough shipping containers to move cargo. This has been a huge issue for many of you over recent months. So the next slide starts to explain what's been happening and what the remedies might be. So firstly, let's try and discount some of the accusations that have been made about the lack of container equipment in the market. This slide here is tracking the total container equipment fleet. This is measured in millions of TEU. That's each of the blue bars for each of the years. And that brown line is tracking the ratio between this fleet and container port throughput. And that ratio is usually around 20 and has been consistently around that level for a number of years. So you would expect then that if there had been a real shortage of overall shipping containers in the market last year and now, you'd expect that ratio to be way, way higher, but it's not. In fact, if you look here, for 2020, it's actually below this long-term average of 20. It's actually around 19.5. And even in the second half of last year, that ratio only just crept up to a measure of around 20. So what that says then is that if you look at globally across the world, there are enough shipping containers. The problem is that they haven't been in the right place at the right time. More on that in a minute. If we move on to the next slide, we'll see that what has been happening is that carriers have been taking measures to try and replenish their fleets through ordering more containers. So I think that for quite a while, there were accusations that carriers had not been investing in the fleet. But in fact, if you look at last year, the total production of new shipping containers rose by, we estimate, around 10%. So in fact, if you look in the first 2 quarters of last year, Looking at that chart, you can see the line moving downwards there. So the output contracted, we estimate, by around 36%. Most of the output comes out of China. These factories would have been closed certainly through the first quarter and into the early part of the second quarter of last year. But in the second half of last year, we saw a big ramp up of production, which rose by almost 80% in the last two quarters of last year compared to the same period in 2019. So overall uplift of around 10%, and in fact this year we're projecting that the output will grow further by a further 40% to get up to the similar levels that we saw back in 2018 of around 4.4 million TEU. So a lot of investment going into new shipping containers. So the big question then is, why have we had all this container equipment availability disruption? So I try to illustrate that in the next slide, which provides a number of different reasons then for this disruption that we're seeing at the moment. So it all really started off a year ago when the carriers started cancelling all these sailings, because the effect of that was to disrupt the repositioning of empty containers back to major demand centres, particularly in Asia. So most of the big trade lanes around the world are heavily imbalanced, particularly the trades originating and destinating in Asia. So what you find is that there is a lot of cargo moves from Asia into, say, the developed markets of North America and Europe. But on the backhaul trade in the opposite direction from Europe to Asia and North America to Asia, for example, trade lanes where many of you will be moving paper and pulp on those trades, those are what we call the backhaul trades, because less cargo moves on those trades, and you therefore benefit from normally times lower freight rates in comparison to head haul shippers. So the carriers then have to reposition large numbers of empty containers to move back to Asia in order to maintain the recycling of container equipment to meet cargo demand. So the cancelling of all these sailings heavily disrupted that recycling. The second thing that happened was that there was this big acceleration and unexpected boom in cargo demand from the third quarter of last year. And this was fueled by an e-commerce boom. Shops were shut, everybody was buying merchandise online, and many still are, accelerating a shift that's been happening for a number of years. There's also been a lot of restocking, which I referred to a bit earlier. So a lot of demand side activity there. And then more recently, we've seen building and worsening port congestion. And port congestion both at the quayside, with many vessels queuing up to get berths in these ports, but also in the container terminal yards, big build-up of containers waiting to be discharged, waiting to be loaded, or waiting to be taken away for cargo to warehouses. And this build-up of congestion there has been made worse then by continuing labour shortages due to the impact of COVID-19 on high sickness levels, either because people are sick or because they had to self-isolate for obvious reasons. This has increased the dwell time of containers in ports and further lowered productivity. And then finally, there's been enormous congestion in the inland supply chain. So warehouses full to busting, full of goods, often using containers as spare storage capacity because they haven't had capacity in their warehouses, a lack of tracking capacity because truckers have been off sick or having to self-isolate. So a perfect storm of so many different things all happening at once. And this has therefore extended the typical cycle time of a container, usually of around 65 days. It's been extended then on certain trade lanes and in certain geographies like Asia to well over 100 days in some areas. So really, the main capacity constraint on container shipping hasn't been so much the ships, it's been the containers. Now, we believe this is a short-term situation which will self-correct and already is, and we're seeing signs of that already. Carriers have been able to start repositioning containers. The Number of blank sailings, as I said, is very, very low now. The Chinese New Year period provided some respite in that regard. There's been big investment in new build container equipment, as I mentioned earlier, and we're expecting to see over the course of the year some slowdown in trade growth as this switch takes place from spending on consumer durables back to services then as COVID-19 lockdown restrictions ease. I think the big wild card is what happens with port congestion. That could linger for a while longer. We therefore expect that there will be continued disruption to the container shipping trade for most of this year, although it will be to a much lesser degree through the second part of the year. And it will continue to some extent in the second part of the year because, of course, that's when the peak season will start to kick in and start to impact the trade then too. Okay, so what does all this mean then for the outlook for freight rates? Let's move on to the next slide. And that shows us then a bit of a summary there, but if we now flip onto the slide following this one, then you can see how rates have been developing through the course of the last 12 months or so. So here I'm tracking the development of spot rates. That's the brown line. Sorry, that's the dark blue line, and contract rates, which are rates of longer term validity, which is the brown line. And we're focusing here on the main east-west trades. These are the trades that originate and destinate in Asia. That's between Asia and Europe, and North America and Asia, and also on the transatlantic, often looking at those trade routes both ways. So whilst contract rates have effectively flatlined because they're fixed for a longer period, and they've actually fell off a bit through the middle part of last year as oil prices fell, which reduced the bunker cost surcharges. Spot rates have spiraled through the roof, as you can see, and all records have really been broken to the extent that current spot rate levels are higher than they've ever been on record. Drury first started recording spot rates back in 2006, and they're higher than they were back then. So they're even higher than they were at the height of the container shipping boom of 2008, just before that financial crash hit. So the rates have been so high for the reasons that I've given you around very strong and unexpected sudden growth in cargo demand and capacity restrictions, both in terms of vessel capacity and container equipment availability, the vessel capacity particularly impacted by this port congestion. But I think the other reason, which is significant here and has more longer term implications, is the way the carriers have behaved in the market. So historically, they had a reputation for self-destruction and managing to bring the market down and crashing rates through excess capacity deployment. We've seen a much more disciplined approach, and particularly through the first half of last year, when cargo was very limited. So that's because the industry is now much more concentrated. So there's a much fewer number of main carriers in the market. The top 6 carriers now control over 75% of capacity. And this consolidation really happened in the last few years, particularly following the bankruptcy of the Korean carrier Hanjin back in 2016. The other thing that's significant is that on the main east-west trades, these limited number of carriers collaborate across 3 alliances. And the alliances are where these different container shipping companies pool capacity, but they still continue to operate as separate entities commercially. And I think so what these alliances have been around for a few years, but they've become much more effective then at managing capacity. The fewer number of carriers in these alliances now means that decision making is much more streamlined. And following the COVID-19 outbreak, I think they realized that they could leverage some degree of market power if they organize themselves effectively. And we think that's quite significant in terms of how the market will develop longer term. So whilst the current very high rate levels we think are relatively temporary, nonetheless, going forward, we don't think we're going to see rates crash down to the levels we've seen over recent years. Okay, so more on that in a minute, because we move on now to look at the freight rate development across particular trade routes. So here we're just looking at the impact on certain key trade lanes around the world. So you can see then, if you look at the trade from Asia to Europe, rate levels are now 4 times higher than they were a year ago. And on the backhaul trade, the trade where you're moving a lot of cargo from Europe to Asia, rates are now twice as high as they were a year ago. On the Trans-Pacific trade, as much as 3 times as high. And on many north-south routes, which are routes that we define as serving, say, Australia, South America, or Africa, rate levels there are as much as 2.5 times higher. So we're talking about spot rates here. So let's move on to the next slide and look at the outlook for container freight rate development. And here we're tracking average annual freight rates at 2 different levels. The brown line is tracking average rate levels across all the different deep sea trades around the world. And that blue line is then tracking average rate levels on just the main east-west trades. Those are the high volume trades where carriers can make or break their profitability. Following several years of low and fairly placid rate development, last year we reckon that average rate levels on east-west trades rose by as much as 27%, and on global trades, in other words, all the main trade lanes around the world, the average increase we think was around 15–16%. So this is by far the largest increase across average rate levels we've seen in a decade. And the last time we saw anything like that kind of increase was back in 2010. But then the trade was recovering from a massive contraction in rate levels in 2009. So a very different set of circumstances here, where actually rate levels have not necessarily been recovering as such, but they have certainly been very low for a number of years throughout most of the last decade, very low rate levels indeed. If we look now to this year, we think that the acceleration in rate levels will continue, and we think average rate levels will rise probably by around 20%. This chart is slightly misleading because it's taken from our previously published Container Shipping Outlook report, which was published at the end of December. So we're currently just finalizing our forecasts, which will be published at the end of March. So the chart doesn't take account of that, but I'm telling you here, hearing it firsthand, we think we're looking at around a 20% increase in rates this year. So what we're likely to see is the very high spot rate levels I showed you earlier will come off, and we're seeing that at the moment. We're seeing rates starting to decline a little bit, and we'll see that through the course of the year. But contract rates, which tend to follow behind spot rates, are now rising quite rapidly. We think that on the main head haul trades into North America and Europe from Asia, rates there could rise by 40, even 50% on certain lanes. On the backhaul trades, where you'll be moving more cargo, we think rate level increases will be lower than that, probably more in the sort of 15% range, but that will vary clearly very much on the particular trade lane. So we think that rates will develop this way because we think that the factors that I've already mentioned in terms of the container equipment shortage, vessel capacity constraints, port congestion, all this these features and the gridlock in the market will really continue to be a feature for much of this year, although will recede in the latter part of the year and hence will support rate levels. We think that in 2022, actually, rate levels may fall off. And we think that's when carriers will come under pressure to demonstrate that they really have some new hold on the market in terms of their pricing and capacity discipline, or wait and see on that. But we think that there will be some slide in rates, but it won't be a significant drop in rates. We think that the carriers will do all they can to manage capacity relatively effectively there. Okay, so we then move on now to the next slide. Here. So if you're worried at all about how to cope with these rising rates and how to mitigate your shipping costs, you could consider joining Drewry's benchmarking club. This is only open to cargo owners, that is, in this case, paper and pulp shippers. It's not open at all to the likes of freight forwarders or carriers themselves. And it's a closed user group that's able to share freight rates with Drewry confidentially, and you receive back information of how your rates then compare with the rest of the market. We have over 100 participants, all big shippers moving very large volumes of cargo, and many of these members then use this as a way of managing their costs to reduce their spend in negotiating with their carriers. It also includes forecasts of freight rate levels by individual trade lane, which will help you plan ahead. So let's move on to the next slide and look at the break bulk shipping market, and move on to the next slide where we're going to look at the development of cargo demand. So here we are, the grey area represents the addressable market of general cargo. So this is all cargo that moves in dry ships, other than the bulk cargoes like coal, iron ore, and grains, etc. So we've removed that part of the market. And then in each of the bars here by year, we're showing the share of that cargo held between multi-purpose or break bulk ships. That's in the light blue part of the bar. And the dark blue part of the bar is that part of the market taken by container ships. So a similar story here to what I've already explained is that in 2020 we saw a contraction, but the contraction in general cargo trade was limited to 1.5%, much less than originally thought earlier last year. And the major part of that contraction happened in the first half of the year, and then we saw a recovery take hold through the second half of the year. For the break bulk and multi-purpose vessels, there was some respite from the fact that project cargo trade remained relatively good for them through the last year, and therefore mitigated some of that reduction. So this year, like containers, we're anticipating quite a strong rebound in trade of around 9%. And then thereafter, we'll see that trade growth slow in subsequent years down to 4-5% level. Obviously, this outlook again is predicated very much on what happens with the COVID-19 pandemic containment. Lots of uncertainty there, and the impact that it has then on economic and trade growth. Right now, we're seeing quite a strong cargo demand recovery. This has been driven by a number of factors. There are seasonal trade flows at play here, particularly around agricultural commodities being moved, and some late harvests, particularly for soybean, which is leading to particular crunch of capacity at the moment. We're also seeing big demand for iron ore shipments into China as well, and through this process then a trickling down then of cargo from the bigger bulk ships down to even the handy size vessels, and some of those vessels, handy size vessels, are moving paper and pulp along with some of these break bulk vessels as well. Also, we're also seeing some cargo that were traditionally moving containers being moved by break bulk and multi-purpose vessels, and some handy-size vessels too, because of the gridlock in the container shipping supply chain too. So it's quite a disrupted market at the moment, certainly taking hold. But over the course of the year, then we think that 9% growth is probably quite realistic, and then tailing off then in subsequent years. So if we now then move on to the next slide then and look at vessel utilization outlook. So here we've created an index where we're looking at the relative development of effective utilization of the two groups of vessels that are particularly moving paper and pulp. So these are the multi-purpose or break bulk vessels, and that's following the brown line, and the handy size vessels, which is following the blue line. So this level of utilization is important because it has implications then for shipping costs. The higher utilized the vessels are, clearly then the higher the fees then for moving cargo in those ships. So the higher the index reading here, the higher the level of utilization, as you can see. So we expect then utilization levels to improve, and you can see that kink taking place in this year in 2021. So there's a big boom in cargo demand is boosting utilization, and thereafter we see utilization improving year on year because the growth in the fleet is expected to be much slower than the growth in cargo demand. And that's particularly true for the multi-purpose or breakbulk vessels, where the fleet is pretty much stagnating, and in fact in certain segments, certainly the smaller vessel classes there, these fleet is contracting as there's less investment in that part of the fleet. If we then move on to the next slide, which is pretty much my last slide, to look at then what this means then for charter rates, which obviously impacts overall freight rate levels. So here we're tracking Drewry's multi-purpose time charter rate index. You can get free access to the historical time series of this if you go to our website. Our web address, I think, is at the bottom right-hand side of your screen. And you can get free access to that, as well as our World Container Index for the development of latest container shipping levels there. So here we've seen charter rates for multi-purpose and breakbulk vessels reach a trough in the middle part of last year, and since then we've seen a recovery of around 25% to the first quarter of this year, and then thereafter we're expecting the charter rate recovery to slow a bit, but overall we're expecting an overall increase this year compared to last year of around 10%, and then a further 5% in the subsequent year. If you look at the handysize sector, anyone who's been following that part of the market has seen rate levels absolutely go through the roof, not quite to the extent that we've seen for container shipping rates. Rate levels are now up to the levels they were at back in 2010 and have doubled since the start of the year. If you look right across the bulk shipping sector, we're seeing rate levels at very high levels at the moment. So this, as I explained a bit earlier, is because of a number of factors at play at once, where we're seeing big increase in cargo demand, generally speaking, but also we're seeing a number of seasonal trades, particularly relating to agricultural commodities. I mentioned the soybean trade out of South America, for example, into China, which has come a bit late and is boosting demand for different types of bulk vessels. And this is having an impact then on the handysize market through a trickle-down effect. There's also building port congestion, particularly in China, as vessels are queuing up to discharge agricultural commodities, which into silos that are currently full. So there are ships waiting then for space to do that. And we have a similar situation in Australia, and also off the coast of Brazil as well. Big pile-up of vessels waiting to get into port. So a lot of congestion. This congestion is tying up vessels and boosting rate levels. However, we think that this is a temporary situation which will reset over the course of the next few months. And in fact, a big indicator of that is that yesterday the forward market prices for bulk ships fell off quite dramatically yesterday, anticipating then that rate levels will soften for the reasons that I've given. So we think, therefore, that the charter rates for handysize vessels will probably end the year having risen on average around 20% compared to last year, and we're likely to see further increase in the following year, but more moderate than that. Okay, so can we go through to the next slide and then quickly on to the next one, where I'm finish off with my concluding points. Okay, so the main conclusion points to take away really is that last year we saw trade contract by 1 or 1.5%, depending on which part of the market we're looking at. It's a much smaller contraction than many people thought, and this was really because of this shift of spend from services to durable goods that we've seen, and that's still taking place today. We're seeing a very strong recovery in trade this year, but the outlook is still very uncertain because of all the uncertainty around the future evolution of this COVID-19 pandemic. In terms of the container freight rate development really much depends on carrier capacity discipline, and that will really come to the fore, I think, in next year when we see many of this disruption dissipates, and therefore the market return to the kind of equilibrium or the status quo that we saw prior to the pandemic, where there is this latent overcapacity in the market. But right now, container equipment availability is the big constraint on the container shipping market. And we think that, along with port congestion disruption, will continue to disrupt the container shipping trade really for much of the year, and therefore keep freight rates pretty high. Although on that front, then spot rates are likely to come off, but we'll see big increase in contract rates that'll affect many of you moving cargo in containers for this year. And then pretty similar story, I guess, in terms of the break bulk and handysize sector, where we're going to see rate increases through the course of this year, but the rate of those increases will moderate through the course of the year as the short-term impacts and effects mitigate. Okay, so that there's one more slide, I think, which is the just the finishing off questions and answer slide, but that brings me to the end of the presentation. So I'm happy to take any questions, Tom.
Thank you very much indeed, Martin. That was most illuminating and very thorough. Thanks again. We are a bit over time, but I would like to just ask you two questions. And one concerns the comment you made about decarbonising the fuel fleet. Basically, is that a constraining factor? The uncertainty regarding the transition away from fossil fuels, is that a big impact on ordering new vessels and new equipment? And my question is on that: what fuels are they moving to? How are they going to achieve it?
Well, it is a big issue today, and so there are targets to reduce carbon emissions in shipping. And whilst these targets are some way into the future, a vessel has a typical life of 30 years. So things need to happen pretty fast if carbon emissions are to be reduced. So there's a lot of pressure to do that, and a lot of investment going into alternative fuels. There are a number of areas being looked at, from biofuels to wind propulsion and others. But at the moment, most vessels are running on fossil fuels. There is a shift away from the use of traditional bunker fuel to using LNG fuel, which does lower overall carbon emissions effectively and is a cleaner fuel, but is only really a short-term gap there. So the effect of that in terms of vessel ordering has been to put a brake on vessel ordering. And hence shipyards have been less busy, and hence to some extent why it explains a bit of the extra vessel ordering we're seeing now, because new build prices are relatively low.
And what I remember this time a year ago, was 18 months ago, there was a lot of discussion about SOx levels and whether or not vessels would have to install scrubbers, or what would be the extra charge for using a low sulfur content fuel. In the end, it didn't seem to be a big issue, or was it? Did it just pass me by?
Well, it was an issue right at the start of last year, but it was very, very rapidly eclipsed by the COVID-19 pandemic, which had the effect of crashing oil prices. And with that crash in oil prices and the abundance of bunker fuel, bunker costs then fell, and critically the differential then between low sulfur fuel and traditional high sulfur bunker fuel reduced with it. So it hasn't been an issue, as you rightly say. However, it is becoming an issue because oil prices have risen, and with it then the differential between these different fuel types has risen. So it is becoming more of a factor now, and that will feed into bunker surcharges that cargo owners will be paying to move cargo.
Okay, thank you. Just one last question, probably a short one, but you mentioned quite thoroughly about the movement of spot rates against container rates, contracted rates. What's the typical length of a contract, and how often are they renegotiated, or can you not make that kind of generalization?
Well, the contract lengths vary a lot, and they vary from as little as 3 months to a year. But many cargo owners will probably contract for a year. Certainly on the Trans-Pacific trade, annual contracts are very, very common indeed, as they are in a number of cases on the other main trade lanes. So hence why you have this time lag, which is usually around 3 to 6 months between the spot market and the contract market. In this case, it's been a bit longer, but we certainly expect contract rates to rise quite sharply this year, and we're already seeing that.
Great. Okay, listen, Martin, there's more questions, but I'm afraid we're going to have to move on. So just remains for me to say thank you once again for an excellent presentation. We'll hopefully have you back in the flesh at some point in the future.
Great, I look forward to that, Tom. Many thanks.
Thanks a lot.
Thank you. Bye-bye.
We have a couple more items on the agenda before we sign off for the day. The first is we'll first hear from one of our sponsors, but before we do, I'm just going to introduce a short message that Roger will deliver on something that's actually a bit more important than pulp, if that's even possible. But over the last few months, Roger has spent a lot of time interviewing his friends and our clients all over the world about how they've been adapting to this new world order. And his message is really a summary of what he's learned, with a few of his personal observations thrown in, of course. Now, as we know, Roger hates public speaking. He's a very nervous guy, suffers awfully from nerves, so he's decided to pre-record his video. However, he is going to be available to answer any questions that might arise afterwards. But before I sign over to him, I'm very pleased to show a short video from Ilim. Thank you.
Ilim Group is the leader of the Russian pulp and paper industry. Ilim's annual production output exceeds 3.5 million tons. Over the last several years, Ilim has invested more than $3 billion and plans to further invest over $2.5 billion. Ilim's key project is the construction of a new mill with a capacity of 600,000 tons of paperboard. Completion of the investment program will allow Ilim to increase its annual production output up to 4.5 million tons with an export focus on Asia.
Hello there. I hope that you're all well and enjoying the show so far. I'm going to spend a few minutes addressing the one hugely important issue which is affecting each and every one of us, the way our lives have changed. We're now living through a cultural revolution that is having a profound effect on the way we live, work and interact. Over the last couple of years, we've seen the emergence of artificial intelligence, machine learning and robots that are gradually replacing humans in whatever task they can perform better than us. Unlike other revolutions, which took months or years to complete, this one happened overnight. One day we were following our usual routine, the next day we were working from home, in many cases on our own. To our pleasant surprise, the logistical and financial workings of our businesses have not been unduly affected by the pandemic. Online communication networks allow data and information to be transferred efficiently, and supply chain management is proceeding as normal, with the usual hitches involving containers, etc. In the first lockdown, there was a phase of euphoria about home working. Time normally wasted in commuting could be spent more productively, either at work, leisure, or with family. However, as time passes, it is becoming clear that personal contact with colleagues, customers, and suppliers is just as important to do job satisfaction as having a little more spare time. We're realizing that personal relationships are extremely valuable assets, even though they're not itemized in the company's financial reports. They are an important part of a company's social capital or bank vault of goodwill. To use a production analogy, think of personal relationships as the lubricants which ensure the smooth running of our business machine. Personal meetings are the way we conduct its essential maintenance. Many years ago, I asked the mill manager why he was closing the machine down for maintenance when it was running quite smoothly. He replied that he'd received many stupid questions in his time, but this was right up there with them. He then explained patiently that machines work well until they break down, and then the cost of fixing things is a lot more expensive than spending a little making more that they don't break down in the first place, making sure, that they don't break down in the first place. We're in a situation where we've not carried out any maintenance on our business for the last 12 months, and nor can we expect to do so for the next few months. This is our big concern. Before we discuss the harmful effects of working in isolation, we have to acknowledge some of the beneficial results. We can see tangible benefits in terms of savings in time and costs of commuting and international travel. Imagine how many hundreds of thousands of dollars have been saved in airfares, hotels, and it pains me to say hospitality and entertainment. The costs of office space have fallen, dependence on physical location is decreasing, and where you live is not so important anymore. With broadband, you could move to a beach hut in the Caribbean. Not you, Tom. The drastic curtailment of air travel and local commuting has also been very beneficial to the environment. We no longer need to feel guilty whenever we see a picture of Greta Thunberg. Well, I didn't anyway. But many people are now enjoying the greater freedom to choose a balance of work, rest and play which suits them. In many ways, their quality of life has improved considerably. Now the downside. Working in isolation is damaging productivity and company spirit. The informal part of any enterprise is where much of the creativity, dynamism and energy lies. And working from home inhibits or stifles, number one, enjoyment of each other's company. 2, monitoring each other's mental and physical health. 3, innovation. And 4, absorbing new blood. Chatting, laughing and arguing with colleagues are vital in maintaining a company's culture. You may learn more next to your coffee machine than looking at your screen. Chance meetings, unscheduled chats, unguarded comments and talking rubbish can be more productive and enjoyable than scheduled Zoom meetings. Without the bonds of togetherness, teamwork and collective understanding, it is impossible for the whole organisation to become greater than the sum of its parts. Even more important, social interaction is vital in monitoring a colleague's mental and physical well-being, which may be affected by working alone. Personal problems only become evident when it's too late to address them. In the UK, almost 2 in 3 workers feel that their mental health has suffered as a result of the pandemic. Younger team members especially find it more difficult to cope with isolation than older, experienced ones. If shops, bars, restaurants and sports clubs are closed, the office may be the only place they can meet people. How can you tell the state of mind of a friend or colleague over the phone if you haven't seen them for over a year? If a colleague is worried about something, they may confess it over a coffee to you, but may be reluctant to bare their souls over the phone. Working from home can stifle innovative ideas. As much as 90% of human communication is non-verbal, which is missed over a Zoom or telephone call. The exchange of ideas, inspiration and opinions which form the basis of innovation has been badly affected. As interactions become mainly transactional with a focus on procedures, individuals may take dangerous risks or be reluctant to take risks, or worse still, take risks without knowing how risky their action is. Telecommunications inhibit spontaneity. You can't speak freely if you know that everything can be recorded. I was once advised never to write, text or post anything that I didn't want to be painted on in big letters on the wall of my house. Zoom meetings can be quite exhausting and very often the only thing that participants agree on is that they should be shorter. You might disagree with something your team leader says in a Zoom meeting, but feel uncomfortable raising this in front of the others. You can't make side comments to your colleagues. Also, the leader cannot judge how well the message is being received in the absence of feedback from your body language. Fortunately, I can't see whether you are yawning, rolling your eyes, or very sensibly have taken this opportunity to go to the bathroom or make a drink. Working separately presents difficulties in integrating new recruits. Problems arise when new people are introduced into the business or friends change roles. They don't have relationships and connections either with colleagues or suppliers and customers. Normally, new employees learn more on the job from watching experienced people operate than they do from formal training. Also, the company is not benefiting from the new skills and ideas they bring into the business, which is why they were recruited. Just as important as internal relationships are external communications with customers and suppliers. Excuse me. Our business is truly international. About 80% of market pulp production is consumed outside the region in which it's manufactured, and 65% of market pulp is shipped across oceans. Because of this, to an unusually large extent, our business is dependent on personal relationships established over many years. Some years ago, I read a book which concluded with the very obvious point that if 3 or 4 people are trying to sell you the same thing at the same price, and one of these people is your friend, you will buy from your friend who you trust. Conclusion, make friends. Making friends is difficult in the present circumstances. We're all aware of the importance of our personal relationships with customers and suppliers. Contracts can be finalised by Zoom, but take longer to negotiate and are more difficult without personal meetings. What is missed most is socialising, getting to know each other better and building trust. The effect of losing the opportunity for personal meetings may not show up immediately because initially, like now, we can draw down on the social capital of pre-COVID relationships. We're now talking mainly to people whom we already know. Developing new business is much harder as there's no existing social bond. Online communication between countries in different time zones with different languages, cultures, incompatible software, etc. is particularly difficult. Although English is the lingua franca, it cannot translate body language. A suggestion or warning may originate in South America, be transferred through a European office to a mill manager in China, none of whom have English as their first language. The original message may be distorted. You may have played the game of Chinese whispers. Without personal meetings, it's almost impossible to establish trust and make friends with a new buyer or supplier. A buyer may have 3 or 4 value proposals to choose from, but he's not been subject to the full force of your considerable personal charm. He has yet to be reassured that by signing a contract with you, the rest of their life will be free from worry. The future. Next stage is the most challenging. Regardless of how the problems of the academic are resolved, more business will be done online than before, and certain restrictions will become permanent. We'll never return to the way we were. We must learn how to rebuild social capital in this new environment. Remote environment management will be a challenge, and new types of leadership skills are needed. The trust between employers and employees is moving to a new level where results are becoming more important than presence. There'll be some work tasks and positions that will disappear completely in company reorganisations. The need for office space and its location are going to be replanned with the growth in hybrid working. Meeting areas with big screens, whiteboards, quiet rooms, places to work out and play will change the office from a place to work to somewhere to collaborate, share ideas and network. Travel will continue to be important, but will be much more focused. It will become less easy, masks, health checks, security, etc., and more expensive. The last few months have shown the difference between what travel is necessary and what has become accepted routine. There's a real balance to be struck between, on the one hand, the cost benefits to an enterprise and the personal benefits of home working, and on the other, the great loss of social capital and consequent risk for business sustainability and happiness at work. In establishing the London and Shanghai Pulp Weeks, we at Hawkins Wright hope that we've provided a platform for nurturing and growing this industry's social capital, and I know that we're all desperately looking forward to the time we can get together again. Here in the UK, we've targeted June the 21st as a date when all limits on social gatherings will be lifted. Our vaccination programme has gone quite well. However, we must remember that nobody is safe until everybody's safe. And rates of infection are still rising in some countries, so it might be rather longer than that before we can meet again. Meantime, spring is here, so we make the best of what we've got. Thanks for listening. Stay safe, everybody. Goodbye.
Great. Thank you very much, Roger. And thanks all for listening. Roger is available for a question or two, although I don't see anything coming in. Just many words of encouragement and congratulations. I'm very encouraged that that we didn't lose too many participants through that last 10 minutes. So well done, Dad. But no, on a serious note, it doesn't pertain directly to pulp, but actually, as I say, it's more important than that, especially in our industry, which is so reliant on personal relationships. But in the absence of any questions, I think I'll wrap up today. Thank Roger once again for his valuable contribution, and just remind you all to please tune in same time tomorrow. We've got another very busy couple of hours to get through. I'm very excited to welcome James Kinge from the Financial Times, who's joining us from Hong Kong, and he's going to be talking about both domestic issues in Chinese economy and society, and also a little bit on the geopolitics, which of course are extremely important at the moment. Then we have Mr. Flavio Deganuti from Clavin, one of our kind sponsors, who has a great presentation touching all the exciting parts of our industry. And then a wrap up with Oliver and Pierre, who are going to dig deep, not just into China, but also into the global pulp industry at large. So thanks very much once again. Have a great afternoon or the rest of the day if you're in the Americas, and I look forward to seeing you tomorrow. Goodbye.